Hello, everyone. My name is Rachel Deshelle. I'm your newest coach here on Schwab Coaching. I am joined in the chat today by Brent Moores. Please chat in your questions and comments during the session today. We're going to cover long options, and the thing we're going to focus on is answering the question of, have you ever wondered how volatility in the underlying security can affect your option price and affect your strategy? So we'll look at these just for a moment on the screen. Just note that options carry a high level of risk, are not suitable for all investors. Everything that we're going to cover today is for information and educational purposes only. Should not be considered any bit of advice. Paper money is a little bit different from live trading. It varies in a couple different ways, and Schwab doesn't really recommend the use of just technical analysis as your sole means of investment research. So definitely do your research there. Now, we are also going to get into our agenda for today. So first, we're going to cover the concept of long options. We're going to discuss the concepts of price, time, and volatility, many different things that can affect your option price and your strategy. And then we're going to go through placing some example trades on the Paper Money platform. And this is going to give us an idea of what our trading process is going to look like for a couple different stocks. Now, the last thing before we really dive into Thinkorswim and look at the markets, we have some upcoming workshops and market drive events coming up real soon. So we had this one this weekend in Orlando. I'm going to be there. So if you're going to be there, please say hi. We have our Anaheim Market Drive November 22nd. Houston, December 11th and 12th. I'll be at that one as well. So if you're going to be there, give me a shout, say hi. And then we have our Miami Advanced Options course really close to Christmas. So we're going to start here by diving into the Thinkorswim platform here and just doing an overview of what the markets look like today, because today we're seeing something a little bit different than what we've seen over the last few weeks. And so let's just start here with the Dow and go down the list for a couple of these. So we've been in a strong uptrend for a lot of these indexes. They've been riding the wave of their 20-period simple moving average. And I zoomed into the Dow Jones Industrial Average a little bit just to show the momentum divergence that's been taking place. We're making higher highs in price. We were making a little bit lower highs in the RSI indicator throughout this time. Each time we've made a higher high, we're making a lower high in the RSI. So it's just giving us a little bit of divergence there, which in its effect, it isn't necessarily a red flag. It's kind of like a yellow flag or a warning signal here, but we're kind of seeing just that little bit of weakening momentum. And so if traders were to look for a little bit of a pullback, they may look to find support at that 20-day simple moving average. Let's go to the NASDAQ Composite. Now, this is where we're seeing something a little bit different today. We're still seeing the uptrend in price. We saw it battle with its 20-period simple moving average quite a bit earlier this fall. We're seeing a momentum divergence in the RSI, still reaching overbought levels, but I think the thing that's notable here is this bearish engulfing candlestick. Now, this is the thing that we're seeing that's a little bit different. It's just that large print showing that there may be a lot of supply at this level. The bears or the sellers may be a little bit more in control at this level here. Now, this isn't a confirmed bearish engulfing for a couple of reasons. One, because the market hasn't closed yet today. And two, because to be an actual confirmed candlestick pattern, we need to see follow through. So we need to see the action of price tomorrow, see if it gives you a little bit of a push beyond those highs, which would invalidate that candlestick. But again, we got to wait for that follow through. And then the same thing in the S&P 500. We're actually seeing this candle today really engulfing the last 3 days. And I noticed Brent put a note in the chat when I mentioned RSI, it's definitely not indicative of a trend change. It's just a change in momentum. So just the speed and price and what it's been moving. So like I said, more of like a little bit of a yellow flag, but the trend is our friend. The trend is still up. We need to wait for follow through in the indexes for that candlestick pattern. And even if we did pull back, if I look at where price is right now compared to the 20 period simple moving average, that's not even a percentage point away. So I wouldn't be surprised if we did see downside follow through, if we followed through to that 20 period simple moving average. So let's look at the Russell, kind of same thing we're seeing here on the Russell. And then lastly, let's look at the Dow Jones Transportation Average. So for all of you old Dow theorists out there, this is one of the first things I learned with technical analysis is just looking at the confirmation of the averages between the industrials and the transports and making sure the averages confirm, or it may be signaling something's going on in the market here. So we're seeing a lot of the same. We're still seeing almost like a downtrend and then a coil happening in the Dow Jones transports, and it's hit its head on this upper resistance line many times, and it's seeing a bearish engulfing candlestick itself today too, which is actually a candlestick that we typically see at highs, but it's in a little bit of a range here, just kind of touching its 20 period moving average too. So that's just some different things that we're seeing here in the market. Again, all pretty close to that 20 period simple as that level of support there. So now that we've covered just a general overview of the markets, let's get into a little bit of our process when it comes to just looking at individual stocks, finding some technical patterns that stick out, and then looking at just the chart on various time frames, deciding whether we're bullish or bearish, looking at the market environment or volatility-based environment for a stock, and then drilling down into our trade components. So the first one I'm going to look at here is going to be MetLife.
Let's pick up where we left off. So we're going to look at the stock Met, and if you could put in the chat, what price pattern do you see here? If you see any price pattern at all. So throw that in the chat and I'll kind of call out a couple things on this chart that we can look at. So over the last year, Met has been in a bit of a downtrend. So I'm just connecting the highs in a downtrend, just kind of showing it kind of fell off a cliff during the March, April correction. Then it's been kind of climbing its way out of that cliff there. And I do see a couple of you guys responses in the chat for an inverse head and shoulders. That is exactly what I'm seeing right here in this pattern as well. So let's kind of draw that and take a look at where our neckline would be. So I'm seeing the neckline right under 82. And we're seeing the left shoulder right here, the head, and the right shoulder right here. Now, a couple different considerations to point out too, because I think one of the main things with kind of looking for this pattern on a chart is identifying first, what is the context of the trend and where does this pattern show up in the context of that trend? And we can see when I connected those highs, we can see that clearly it was in a downtrend. You could argue it's in a bit of a recovery or at the top of the shorter term trend, but we're going to say for this case, it's been in a downtrend. It's going through a little bit of repair. Now, the next step I'm going to look at when identifying this type of pattern is looking at the volume trends down below. So that's why I put the volume here. And typically what you'll see during an inverse head and shoulders pattern, which is basically like a person turned upside down, versus, and as well as a regular head and shoulders pattern, you'll typically see these increases in volume throughout the shoulders and the head of the pattern. And typically something you'll see is an additional increase in volume on that formation of the last shoulder. So in this case, the right shoulder here, where we saw that big push up, and then we've seen a breakout since. And so some traders would say, hey, this is a pretty valid pattern. This is a confirmed pattern. We have actually three, well, today, if we close above it, it's going to be 3 closes above the pattern. We did have a little bit of a early breakout, a little bit of a retest, and then it went to breakout again. So I know confirmation looks a little bit differently for each and every one of us. So we always want to say, you know, have your own rules when it comes to looking for confirmation above a pattern breakout or resistance breakout in this case. So maybe looking for a 2% break above that line, or looking for a 2 or 3 closes above that line, whatever that confirmation looks like for you. I'm going to go with, for the purpose of just our trade ideas today, I'm going to go with this being a confirmed breakout for us to place a long options trade, in this case, a long call. So let's go through some different considerations of what that bullish trade would look like for the right to buy the underlying stock at a certain price by a certain date, or just participate in the up move of that stock. So let's look at a couple things first, just from the pattern that we're seeing. So if we just take the depth of this pattern from the neckline, which is just under 82, all the way down to the head, this will give us that measured move of the depth of the pattern. So we want to look to the deepest part of where the head occurs up to the neckline. And we're just going to duplicate that drawing and project it upward. And so we can see here, if we adjust our price scales a little bit, we can see where that actually ends up, which is right under 92, right around like 91, 92 or so, which actually puts the price above where our highs were for the year. So for me, looking at this, or for traders looking at this in this case, they may put their price target right around 89 or so, because they may look at that being that longer term resistance. So they may think that price may stall out a little bit there, rather than like continue to its entire height of the pattern. So when I'm formulating this trade, I may just look at those former highs as a little bit of resistance. Now, let's kind of look at a couple other things, because right now we're obviously just looking at the underlying stock price. We need to make sure it's a good type of market environment for us to place a long options trade, because we want to make sure, since there's many different factors that affect the option price, we obviously have time, we have movement of the stock, speed of movement of the stock, interest rates, and volatility that are all going to impact the price of our option. We want to make sure it is the right type of market environment for that type of trade. So the next thing I'm going to do is actually take a visual look at what implied volatility actually looks like on this chart. So I'm going to add implied volatility there from the studies, and that will give me a little bit of a picture. I'm going to hide the volume actually right now. We're going to hide the volume subgraph to give us a little bit more space to see the volatility. And the reason I'm pulling this up is because typically in a lower volatility environment, we want to likely be buyers of options, because volatility, when that enters the market, that also enters the price of the option. So when volatility is low, we can have the opportunity for a little bit of a cheaper price on the option. And then when volatility starts to creep up and increases, so do the prices of our options as well. So that's going to be one of our factors that we're going to look at today. And we can see when we're putting a implied volatility reading here on the chart, even just looking at a chart of this over the last year, we can see we're at relatively low levels of implied volatility. And another thing we could do is really rank implied volatility as well. So if any of you have heard of the implied volatility percentile, there's a few different places to view that on the platform. You can scan for it. You can view it on the options chain, which is where we're going to move to next. And then you can also view it on a watch list as well. But essentially what that implied volatility percentile does is it takes all of this chart data over the last year of where implied volatility has been, and it really ranks implied volatility on a scale from 0 to 100 as far as how high that volatility is relative to itself over the last year. So that's going to be the component that I'm going to look at on the trade tab as we kind of move over to here for the next component. So if we look at the trade tab here and look down under today's option statistics, we can see the current implied volatility percentile is about 20. So for those of you that are scanning or searching for stocks that have a low implied volatility percentile, this is giving us a relevant reading because it's in the lower fifth of its last year of data. So this could be something you could enter into a scan using the study filters and search for implied volatility percentile. Like I mentioned before, just to add another factor to your process. If you already have a watch list of stocks that you're watching, you may want to cross-reference that and kind of scan within that for a lower implied volatility percentile if you are thinking of buying calls or buying puts. But since in this case today, we kind of set up a bullish trade on the chart, so we'll be looking to buy a call. And let's kind of look into how much we want to put into the trade, what we want to select for our expiration, our strike price, and some different things like that. So I guess one more thing to note, this pattern took place over a period of a few months. So in this example trade, I want to really give myself enough time for price to really hit those highs or really hit that target that we were looking for. So that we're going to give ourselves a couple months when it comes to just selecting our expiration. And the other thing about selecting our expiration when we're long option holders, we're going to be affected quite a bit by time decay. So let's look at that on the option chain and just see how much time decay we're going to see for the 16th of January 2026, which gives us a few months in time for us to hit those price targets. So the first thing that I did was I customized this option chain here just to show the Greeks, which are some of those quantifiable factors that of option pricing, about volatility, time decay, direction of the stock, things like that. And then I put a couple other factors on just to show the liquidity in the option. So if you want to customize your option chain, you can just click on that button and customize and save your own columns from there. So if I wanted to save this, I could just go here, name it how I have it, hit save, and it actually shows up as a custom column set down below. So when it comes to selecting our strike price, I want to look a little bit in the money so that my option has a little bit of intrinsic value here. So I'm going to look at the 80 strike option in this case. I can see it has a delta of 64. So that's telling me that there's about a 64% chance that that option is going to expire in the money. We also have about a 64-cent move on every dollar that the stock makes for our options. That's what it's telling us for a couple of things there. And then because this is so far out in time, we're giving ourselves about 3 months here in time. We're not going to see too much time decay, only about 2 pennies per day. So this is kind of something that I wanted to mention as well. And then if we have any changes in implied volatility, I think we saw the implied volatility was at a level of 28.68 right now. So let's just say that's 29%. If we have a 1% increase in implied volatility and it goes up to 30%, we're going to see about a 16-cent move on that 620 option. So those at the money, slightly in the money, and slightly out of the money options will have the greatest sensitivity to implied volatility in that case. So that's kind of one thing to look for as well when selecting that strike price too. But in this case, we're going to go with this option as an example, and I'm going to right click on the option, go to buy custom with OCO bracket. And the reason I'm doing this is because so many times as a trader, and I'm sure many of you guys have experienced this as well. When I first started trading, I was not putting stops on my we do have pretty light volume because we're a little bit further out in time. So there's a little bit less volume here than there is on some of the closer expiration dates here. But we can also look at open interest to see how many open contracts there are. So that's in the second sense of liquidity. And there is still a great amount of option contracts that are open. So there's still a good likelihood that someone's going to take the other side of our trade. We still have a pretty tight spread, only 20 cents between the bid and the ask. So that's definitely a good thing to take into consideration. And especially when I was looking at these options this morning, there was wider spreads on these options too, right after the market had opened. So great question. These are all things to just kind of consider. Is I'm mainly looking at that open interest, just seeing the open number of contracts, and then just looking at the difference between the bid and the ask, just seeing the spread and making sure it's no greater than probably like 10% of that option price there. So coming back down to the trade, we built this first triggers OCO trade. We're going to go through a couple different components of the trade here. So I'm going to add up to actually 4 contracts on this trade. And the first step on how I got there, just looking at the size of this trade that I'm going to place, is looking at the size of my account. So I rounded down to $128,000, which is the number that I'm going to be working with here. And I don't want to place a trade that's going to be more than 5% of my account. So that caps me out at around 6,400 that I would place in a trade. And I don't want to risk more than 1% in my trade either. So I don't want to risk more than roughly a little less than $1,300 in a trade. So I'm going to keep those really components top of mind as I'm building out this trade. And we're going to go back and forth and look at the price chart and put in some of those levels as well. So when I'm entering this order, since I already saw my confirmation take place, we had 2 closes above the neckline. We may have 3 today because it looks like we have a little bit more of a push. We are just going to keep that price as the same, so 620 right there. Now for our stop, we're going to come down here and we're going to say that we don't want to take more than a 50% loss on this trade. So that still gives us a good amount of room to work with because we have about $3.10. If I take that times 400, $3.10 times 400, because that's the number of contracts we are controlling, our shares we are controlling, that gives us about 1240. So that still puts us within our risk parameters of where we could be stopped out at. Now for our upside, since we don't know what the price of the option is going to be when this stock possibly hits our target price, and we talked about our profit target of about 89, because that's where the old highs were, we are going to actually use a conditional order and make our profit target based off of the price of the stock. So I'm going to come in here and click this little gear wheel here to the right hand side, and I'm going to put in the symbol mark is greater than or equal to 89. Now, since we don't know what the price of the option is going to be, and we noticed, hey, there may be some light volume, there may be at times where this option may have wider spreads, we're going to look out for ourselves in that way where we could actually change this limit price, and we could unlink it and link it to the mark price. So this is basically saying that when the stock price is greater than or equal to 89, whatever the price of the option is at that time, we want to base our limit price off of the mark price. And we want to say we're going to select 10 cents above the current mark price. So that's going to give us, we're not just going for the mark because we know that we're not always going to be filled at the midpoint. This isn't, paper money isn't the same as live, but we can give ourselves a little bit of a buffer and ask for a little bit more than what the midpoint would give us. So just in case we did have a little bit of a wide spread there. So that's where we're going to put the limit there. So I just clicked that little link, change the limit link to mark. So it's really saying whatever the price of the option is at the time when the stock is at or above 89, we are going to send in an order that is, well, I guess actually we should do minus. I caught that. So we should do minus 10 cents because we'll be selling it. So we're going to ask for a little bit less than the mark price to see if we get a fill there for whatever the price of the option is at that time. So I'm going to hit save. Now the next thing I'm going to do, I just got a question that says, can you please show again how you unlink limit price and link it to the market? Yes, we will go through that again. So you can either unlink it here. So you can click on that little link there and that will link it to the price, or link it to the mark, which is what I did in this case. Or when you're in that conditional order entry window, you can click the little link right here and that will link it to the current price or to your offset of whatever you want it linked to. And again, I just chose mark there. You can do bid, you can do ask, but because of the wide spreads, that's why I chose mark. So I'm going to go back into this order ticket. And the next thing we're going to do is just double check this trade. Well, I guess before we're double checking it, one of the things that I noticed is we want to make this order good till canceled, because we don't know over the next 3 months when the price of the stock is going to reach those prices. We don't know if it's going to go down to that price and how long it's going to take to get there. So we're going to make that all good till canceled. And then we're going to confirm and send our order. So this is saying that we're going to buy 4 contracts, which again, still staying within our trade size there, still less than $6,400. And then staying within our risk parameters here on the downside of 310, good till canceled. We have our conditional order there. And so that is where we will be placing this order. So I am going to hit send since we double checked everything. And we just heard the little bell go off. We got a fill. We could check it over here. And in future webcasts, we will be actually checking in on these trades, seeing how it's going, kind of managing these trades as we go. So keep in mind that is going to be something that we're going to do. So we have our first trade done there. We can check it on the working orders. We can see it there. Now let's go to another stock that I've noticed is forming a little bit of a pattern too. Okay, let's take a look at this one. So SATS, it has gone a little parabolic in the last few weeks. We can see it had a strong up move. We see a very big gap up, creating almost like this flagpole. And then we've had a little bit of this like really tight consolidation that's occurring here and creating almost like a pennant. Now, if you're really aggressive in this case, which I'm not going to be for the example of this trade, this is a $55 move. And so with a flagpole, traders will typically project that to the upside to just show that this is a bullish continuation pattern. But in this case, they may start at the start of that move, which is the start of that gap. More conservative traders would probably start at the end of that gap just because that gap size is so large. But for today, I'm actually going to just look at this last little bit of price action here. So I'm going to look at just this coil that has been taking place over the last few weeks. We can see price really compressing. We've had a couple We've had a couple hits on the top of that resistance trend line. We've definitely had a couple touches on the lower support line as well. We're kind of hanging on the edge of that today. And then we've had at the same time that price is coiling, which is typically what we're seeing. We're seeing that lower volatility or that volatility compression. So if we're looking at this move and we first kind of pointed out that it could be a bullish pattern taking place. So it could be a bullish pennant pattern, maybe projecting that to the upside. That gives us the bias that we are going to be bullish in this case. So we may be looking to buy a call in this case. I know we just bought a call in the last one too, but we're seeing a couple bullish patterns taking place here. And I'm going to be a little bit more conservative when projecting a possible price target in this case. So I'm going to actually measure from the base of the pattern, looking at the high of the pennant down to the lows that were made at the first move of support. And that is going to give me about a $15 move. So I'm going to duplicate that. And since I'm saying that the bias is up, that puts a profit target up near 95 or so. So that's kind of where I'll be looking as far as where to possibly place my entries and exits here within this, with taking an options trade within here. And a couple things to note. I know with technical analysis, it's great at analyzing price, analyzing momentum, analyzing relative strength, all these different things that we tend to look at as technicians. But the one thing that we want to keep in mind is that we do not want to use it to anticipate price action. We just want to use it to react to price action. So we are not going to trade an early break of this pennant or triangle pattern that's taking place. We are going to wait till we have confirmation above or below these levels of support or resistance. And in this case, since I have a bullish bias, I really only want to take the trade if it actually goes 2% above this resistance line. And you'll notice this resistance line is obviously sloping too. So if we don't get filled today or the next day, we're going to have to keep monitoring our trade because this slope is just descending throughout this. So that's kind of one thing to keep in mind as these patterns are forming, as you're waiting for your confirmation. You may need to adjust the price a little bit as you go, just kind of day to day and monitoring your orders there. So let's take a look at this one on the trade tab. So we have SATS. We already saw that it had a pretty low implied volatility level, and that relates to the percentile of about 8. So we can see price is really getting compressed right now. Volatility is really getting compressed, and volatility is typically mean reverting. So that's kind of why we were looking for these lower levels of volatility, so that when volatility does start to increase, specifically on breakouts of support and resistance, we have that influx in price that occurs within our long option too. So that's just kind of another reason why we're looking there. Now, this pattern has taken, let's look how long it's taken to form. So it's about a month in time that it's taken to form here. So we're going to give ourselves a little bit of time for a price target to be reached. And we're also going to just give ourselves a little bit extra time as well, just so we don't see that time decay. Because if we're giving ourselves about 30 days for this pattern to play out, since it took 30 days for it to form, we don't want to be only 15 days out by the time that price target is reached, because we will have lost a lot of time decay in our option if we let that amount of time pass. So we're going to look a little bit further out at the 19th of December, giving ourselves about 73 days in time. And again, we're going to go through our same checklist of just looking at volume, looking at open interest, looking at the spread between the bid and the ask, and then looking at how many contracts we could possibly enter into in this trade, just looking at the trade size within our account. So in this case, we're going to kind of do a similar thing that we did before, where we're looking at a little bit in the money. We're looking for a little bit of intrinsic value here. So in this case, I'm going to look for a delta of about 56, looking at the 75 strike call here. And we can see here there's been quite a bit of volume today. We can see there's definitely over 7,000 in open interest. So we have a lot of open contracts there. And so in this case, we're going to kind of, we checked all the boxes on different things that we're looking for. And now it's safe to kind of start crafting this trade here. So I'm going to right click on the option, buy custom with OCO bracket in this case. And I can actually place up to, let's take a look. We have about $6,400 that we could place in one trade. And if this option is 780, that tells us that we could do up to 8. Is that 8 contracts if we wanted to? So if we wanted to do that, we could bump this up. So we could do 8 contracts if we wanted to. We're going to go a little bit smaller today. We're going to just do 5, because that's kind of what we're just doing little small trades to get started here. So we're going to do 5 contracts. We have those all linked together. And we're going to do a little bit of a similar thing that we did in the previous trade, where we're going to look at the price of the stock and just see where we could possibly put our profit targets, where we could possibly put our stop loss, just to make sure we are taking our profit while we have it, and we're managing our risk as we kind of go along here. So we're going to use this as the profit target at 95. We're projecting the base of the triangle up to the breakout point because our bias is bullish. So we're going to say 95 to our upside. So I'm going to click on this little gear to the right-hand side again. I'm going to type in the symbol, say greater than or equal to $95. And we are just going to link the price. Oops, we're going to unlink the price, make it manual, or I guess link it to the mark price in this case. And we are going to do the same thing we did last time, where we want to sell if it is whatever the price of the option is at the time. We want to put our price just 10 cents below the mark to just make sure we take our profit there. So I'm going to hit save. And in this case, we are also going to put a stop on for, let's see, 780. I'm going to take 780 divided by 2. That places us at 390. So that's if we're going to take about a 50% loss on the option. Now, to make sure that's within our risk parameters, we're going to take 780 minus 390, because that would be an exit price. And we're going to take that and multiply it by 500, just to get how many shares we're actually controlling with this. And that's telling me that I'm taking on a little bit too much risk here. So in that case, we're going to bump it down for a couple different, just a little bit lower with the contracts to make sure I'm not taking on too much risk, because that would have been close to $2,000 that I'm risking in a trade. And I think we talked about in the beginning, we don't want to risk more than about $1,300. So I'm going to back that down a little bit. And now we're safe within this zone. We're going to make this order GTC, which means good till canceled. That will be good for the life of the order. And we are going to double check this before we send it. So we're going to slow down, take our time, double check that we are placing this order to buy, oh, we got to go back and actually change this price as well. So we forgot the first part, which is actually our entry order, which we're going to base that off the price of the stock and this declining trend line to make that a conditional order too. So I'm actually going to come back to this, make this a conditional order, and actually say that we only want to buy this when it's greater than or equal to 2% above that neckline or 2% above that resistance line. So that is going to be when the stock is about, let's say about 80.65. So when the stock is greater than or equal to 80.65, we're going to link this to the mark price, and we're going to just place a limit that's linked to that, whatever the market price of the option is at the time, or whatever the midpoint is of the option at the time. We're just going to ask for 10 cents above that. So we're going to hit save. Now we're going to confirm our order. See, that's why you always want to confirm your order, because you can forget little mistakes like that, because this trade is a complex trade. There's many different components with it. So we always want to go back and double check our trade. And we are going to send this trade here. So that's going to only fill if that condition is met, if we have confirmation when the stock is 2% above that resistance line there. So we have our profit targets and stops. So what did we do today? We went and we slowed down. We looked closely at what's happening with the price of the stock, what's happening with volume alongside price. We went through just checking the implied volatility of the underlying stock, looking at how some of those factors will affect the option price. And so hopefully this helps just give you a couple other tools in your toolkit as far as what volatility is going to do to impact the price of your option, and different things that you could look for within your research process when identifying stocks to place options trades on. So in closing, thank you everyone for your time today. This was my first webcast ever, so thank you for being here with me. And if you want to follow me on X, I'm Rachel-CS. And please like this video, give it a thumbs up if you had a good time today. And I just want to thank everyone in the chat, Brent for helping out, the production team for helping out, and stay tuned for the class that is up next, Getting Started with Technical Analysis with Barb Armstrong. Thank you, everyone.